truth be told, there's not a huge amount of corporate news due on either side of the Atlantic in the coming week, although we do have full year results from Smiths Group on Tuesday the 24th of September, quarterly results from American silicon chipmaker Micron on the 25th, and trading updates from Halma and Pennon, as well as figures from Swedish retailer H&M and quarterly earnings stateside from Carnival and Best Buy on the 26th. The macro's fairly quiet as well, barring flash purchasing managers' indices on Monday the 23rd, and the German IFO and Belgian Kurb Synthetique surveys on the 24th, which will provide additional insight into the trajectory of the EU economic bloc. But as a result, given that it's a little bit quiet, we're going to take a bit of a step back and look at commodities this week, and gold in particular. The precious metals nearing a new all-time high at around $2,600 an ounce, nearly 3/4 higher than 5 years ago, and a round of mergers and acquisitions involving gold miners continues apace, with a bid for FTSE 250 member Centamin from South Africa-based and New York-listed Anglo Gold Ashanti. Now, fans of gold may have many different reasons for warming to the precious metal. Some see it as a hedge against inflation, given how well it did during the 1970s. Some see it as a hedge against deflation and recession. Others see it as a hedge against some unknown, unknowable accident, where central banks are not in control and prove to be mortal, rather as the masters of the universe that some see them, and the metal did do well in the early 2000s in the run-up to and the aftermath of the great financial crisis. Others see it as a store of value at a time of sovereign fiscal incontinence and soaring budget deficits in the US and UK, a situation that they argue means the endgame is, if history is any guide, either default, unthinkable, war, let's hope not, growth, well yes, that would be fantastic, but it's not proving easy to find, or inflation and money printing to erode the debt and manage the interest payments. Equally, there are those who have absolutely no interest in gold at all. Master investor Warren Buffett says it's an inert metal with limited industrial use and generates no cash flow, and that a Martian wouldn't know what to do with it if they came to Earth and fell over it and tripped on it. Gold miners, however, can turn the metal into cash flow, but the stuff's hard to find, expensive to extract, so even sitting on a gold mine's no guarantee of riches, especially as junior gold miners in particular have a bad habit of needing more money and issuing more shares, with the result that the investors either regularly tapped for cash or diluted down. Note how the New York Stock Exchange ARCA Gold Bugs Index, known as the Huey, has hardly covered itself in glory since inception in 1997, and it's badly lagged the latest run in gold. Equally, that may simply inflame the ardour of gold bugs, who will argue gold is cheap relative to equities, as the metal trades near relative to all-time lows against the FTSE All World and S&P 500 indices. Gold fans may even argue that gold miners are cheap relative to the metal, using the Huey as a benchmark. Now, these are all questions that you must address for yourself, and only you can decide whether gold or gold miners fit with your personal investment strategy, target returns, time horizon, and appetite for risk. Gold miners have, however, embarked upon a round of deals to suggest they think something's happening, and in the past few years, Barrick Gold has bought Randgold Resources, Newmont has bought Goldcorp and Newcrest, Agnico Eagles merged with Kirkland Lake Gold and then KW Havana Gold alongside Pan American Silver. This year alone, Shanta Gold has been acquired, Goldfields has bid for a Cisco, and now Anglo Gold Ashanti swooping for Centamin in a cash and stock deal. If you think this is a hint worth taking, and I stress if, and one that justifies the risks, then it could be worth researching the following if you decide to look at gold miners, rather than an actively managed fund that focuses upon them, or a passive fund or tracker that follows the performance of a basket of miners, or indeed just the metal itself. So when assessing a gold miner, you need to think of the following: whether it's already producing, in the exploration phase, or is in the process of obtaining and making the most of a license. If it is in the production phase, well, the next task is to assess the size of the resource and the production profile of existing mines. Then you need to look at where the company operates and the risk, or otherwise, of difficulties with local governments over mining rights and taxes, as well as the susceptibility of individual mines to problems posed by difficult conditions such as weather or geology. You then need to look at the all-in sustaining cost, or AISC, of producing an ounce of gold, as this will reveal how profitable or otherwise the firm could be relative to the prevailing metal price. Some miners publish a cash cost figure, but that may not include third-party smelting, refining, transport costs, local taxes, office running costs, and so on, so it may not give the full picture. Key cost variables also include staff, diesel, fuel, even equipment, and they can be affected in turn by local currency movements in the countries where the mines are situated. Also look at the experience and skill set of the management team and executive board, the balance sheet and how much cash or debt there is, And finally, of course, the valuation of the stock in absolute terms and relative to its peers. Multiples of book or net asset value may be more helpful than earnings or yield. Again, given how much they can vary and how cyclical they can be according to the metal price. But again, that will all depend upon your own personal needs, goals, and preferences. I hope that you and your families are all keeping well. Thank you for watching, and I look forward to seeing you again next time.